Hello, everyone, and welcome back to Tell Me Your Story. I am Coach Danny here, and today I have an amazing guest. She is a benefits and senior care specialist. So go get all of your senior friends, even the young people, because this is the video you don't want to miss. And she will be joining us in by phone all the way from Minneapolis, Minnesota. So I'm going to get Bavonyalle on the line. Hi, Bavonyalle. How are you today?
I'm well. How are you?
I'm doing well. Thank you so much for asking. And welcome to Tell Me Your Story. It's such an honor and a pleasure to have you here today.
I appreciate you having me on.
Oh, thank you so much. Absolutely. Now, I'm just going to kind of take us right into the type of services that you serve and what you have. And prior to our recent conversations and upon some of my own research, you are a benefits and senior care specialist. Is that correct?
Yes, ma'am, that is.
Okay, great, wonderful. Now, what benefits or financial programs are people missing out on? Because you seem to have all of the goods. What are we missing out on? What can you share primarily with our seniors? What type of benefits that they should be seeking after?
Well, the biggest thing I see is a lot of people is missing out on financial programs simply because they don't think they exist or nobody has really sat down and explained it to them the right way. Like, for example, annuities. Some people still have their money in a savings account, a regular savings account. Now, there are other options as far as the high yield savings account, but the money in the savings account is really not doing anything for them. So they're afraid to lose their money on the market or something like that. And then there are other options out there that are safe options and can help still protect their money.
Right.
Yeah,
Absolutely.
but some things like with Medicare, people think they have it all covered. Medicare covers everything. Medicare doesn't. It only covers 80%. You're responsible for the other 20%. So there are plans and options out there that kind of help fill in the gaps, such as hospital indemnity plans or something like that can actually help fill in the gaps.
Absolutely.
And then there's Index Universal Life programs, the IULs, that allow people to grow their money compoundly, and actually, which the term is that people growing your money become your own bank. You can borrow from it.
Wow.
So opportunities.
Absolutely. Now, you mentioned Medicare. So I know most seniors every year they get this big thick package in the mail that says Part A, Part B, Part C, and D. And a lot of them are confused. They don't know exactly where to start, where to begin. A lot of it has fine print. They don't understand what they read. And even some of the adult children, they don't understand what they're reading. So is this kind of where you come in at? You point them in a direction to where they need to be?
Yes, absolutely. First, I would just want to know where you're trying to go. What protections are you looking for, and how can I help you navigate those particular areas that you're looking for? Because when it comes to Medicare, it can be overwhelming. It could be complicated. People try to figure when they're turning 65, they have to hurry up and rush and get Medicare, when actually that's not the case. If you're turning 65 and you still working, as long as you have qualified insurance through your employer, you can hold off as long as you need to or till you feel comfortable. I have clients that are 67 and they still want to wait until they feel like if they can hold on for another 3 years and retire at 70. That's beautiful. That's more money into your Social Security. So it just depends on where you're trying to go when it comes to the Medicare or any other product that you're looking for.
Absolutely. Wow. And that is so powerful. So there are people who still want to work to 70, not because they have to, but is it because they want to get to those full benefits? They're going to gain more in the end? Did I understand you correctly?
Some people are afraid. A couple of people in particular, I won't share names, but they're afraid of the next, what's going to happen next. Okay, and when I turn
For sure.
70, I got this stable income. I know I'm going into, now what? You know, so some people are afraid. Some people look forward to retirement. And, you know, they've worked 30 years and they don't have nothing left. So it's
Absolutely.
just basically on the individual what they're looking for.
Okay. Okay, got it. Now, next off, how do life insurance and trust funds help family build wealth? Tell us a little bit about that.
That's a good question. And it really just comes down to strategy coming in. You know, life insurance and trust are like two of the most powerful strategic programs that you can actually use to build real wealth and right up front. So you can actually structure a life insurance policy, and the way you structure it correctly, and then you allow the trust to be the beneficiary of the life insurance policy. If something happens, you know, the trust actually becomes the beneficiary, and then it actually structures out how the money's paid out to the beneficiaries and where it's going and so on and so forth. So that way the money is not blown through. So properly structured, it can create wealth. It can make sure that the beneficiaries are set up properly if it needs to go further. And so it's one of the most major tools that the elite use and other people use, but it has to be done correctly. It has to be structured correctly.
Right, absolutely. Now, I think I heard you mention the trust fund itself can become the beneficiary. Did I hear that correctly, or?
Yeah. Yes, absolutely. When you have a life insurance policy that's structured correctly, it can build wealth. It can get compound interest. You can borrow from it. This is how you can become your own bank. And it actually creates wealth once immediately when the trust is the beneficiary. It can pay off bills, send some of your kids to college, and you know, you can borrow from it to get assets, so on and so forth. But it's a major tool.
Okay, now, for example, if I had that set up and I passed away, if the trust fund itself is the beneficiary, how does that benefit my children, my grandchildren? Because we talked earlier, I know you have the goods, so you tell us how does that work in terms of the future if we were to take that next step?
So what you would typically do, like when I say structure correctly, you actually have your life insurance policy like a step-by-step program on how that will actually go. You know, so you can say, upon this date, if this happens, then this amount of money can be simplified in layman's terms. This percentage can go to my children. Okay, and that's for that individual to go to school or to finish college, or if they complete college, they're able to get this amount of money out structured with that.
Wow.
And then you leave a percentage and you continue to go. But a lot of people don't understand is that when you have beneficiaries, this is one of the other reasons how wealth is created. When you have beneficiaries, put the same form of life insurance policy on the beneficiaries. And then when they have children, put the same form of life insurance policy on them. This is what you call a waterfall method. So
Okay.
if something happens to them, now guess what? That life insurance policy goes back into the trust and it creates wealth.
Mm-hmm. Okay, now I heard you mentioned, you said if something was to happen to me, for example, if I passed away and the funds get dispersed to my children because I had set that up prior to. Now, is the trust fund done and over with? Can the kids take it over, put their name on it, or what happens after you're gone?
That's a good question. So when you have that life insurance policy and you have that trust, it's each one teach one. You show your children how this operates, how it's ran, how to take minutes, how to structure the next generation correctly. You know, you can give out funds to the beneficiaries, but you don't want to liquidate the trust either. You want that trust to work for you. Just like an individual will go to their job, punch in, make their paycheck, and then get a check on Friday. You still want that trust to actually continue to work money for you. So you teach your children how it's structured. And a lot of times these are like spendthrift trusts. And so on, where they actually, you have this has to happen, and this has to happen, and this actually has to happen. And then you assign a trustee upon your removal, and then they will actually take over and run it the same way that you had it structured. So it's like an each one teach one type of thing.
Wow, how powerful. Absolutely. So everything you just said is very powerful. And see, a lot of people aren't even aware that this type of stuff is out there because and for many of them, they think because it's going to be expensive. So what is the average startup that or funds on hand that a person would need to get inside a trust fund?
Well, it basically depends on what you're actually looking for and how you're trying to structure and how you want it to grow. So having a particular dollar amount is kind of blasé to say, because you don't know exactly what you want until we actually sit down and have a discussion with you on how it's supposed to structure, how you're supposed to fund it, and keep it going, and what you're actually looking for. You know, you can go and get a trust from other entities, and it doesn't do you any good. It doesn't protect you at all. You know, you can go get a life insurance policy that doesn't grow, you know, and doesn't create compound interest. So it's just basically what you're looking for and how you want this to be constructed, because we're looking in long term. A lot of people look at right now, and they don't look at long term. And the problem is they get something too late. So you're in your 50s and your 60s when you want a life insurance policy. It's a lot more expensive than it is when you're in your 20s or your 30s.
Absolutely.
You know, so creating that is one of the biggest things that people lack in.
Okay, absolutely. Wow. Thank you so much for sharing that. That is awesome. And you are absolutely correct, because when most people feel and think that they're going to die, let's just say for the next 15, 20 years, then they want to get a life insurance policy. But it's best to start it off as soon as possible, is what you're saying.
Absolutely. Absolutely. So if you even have children, 30 days old, get a policy on them, get an IUL on them, and allow that to grow. By the time they're 18, if properly funded and properly structured correctly, you might be creating a millionaire at 18.
Sure. Absolutely. Now, and it sounds like these are the type of funds in case of an emergency. If they want to take a vacation, are they allowed to pull out some of the funds that they've generated over the years? Do they have to pay it back? Is it a borrow?
Absolutely. You can borrow monies from this. You can actually use it for vacation, to pay off bills, so on and so on. That's what the term become your own bank actually means. You're able to use these funds and borrow from in case of emergency or business pleasure or whatnot. And then you pay it back as you go, and it's off of a fixed interest rate that you can actually pay back. So yeah, you definitely can use this, and it continues to grow as well. So that's one of the key positives. It continues to grow as well.
Absolutely. Now, when we take these funds out, are we borrowing it? Is it a loan? Does it have to be put back? Do we get penalized for early takeout?
No, absolutely. No penalty for early takeout. Yes,
okay.
You own literally your own money. So you can pay it back. You may not pay it back right away. You may not even get to the point where you pay it back. So if that's the case, what it comes off is the base amount. So if you have $1 million policy and over time you just happen to borrow, 100,000, and your policy done grew over time, it's actually going to take away from that 100,000 from either the growth or the face amount if you haven't paid that back.
Wow.
So that's where the reduction is. So, but your family policy is still in effect.
Okay. Well, thank you so much for sharing that. Wow, all of that is just great, juicy information that we're not even aware of. We're missing out on all of these benefits. But my goal here today is to try to get people to get a hold of these benefits, to connect with you and your team and start getting some of these pretty much free benefits, if I could say that, because a lot of times we're worried about the cost, but if you just look into it, it may not be as expensive as we think. Okay, next off, what mistakes do people make with benefits, insurance, or estate planning? Because when you mention the trust, I'm assuming the estate planning would be somewhere inside of the trust.
Yeah. Well, honestly, this is where a lot of people, they pretty much go wrong. The biggest mistake that I see is people not preparing for the long term, and which is really just a strategy, So, say for instance, like life insurance, they get a life insurance policy, but they don't get the right life insurance policy. You want something. If you're going to put money into something, as an asset, you will want your asset to grow. So just getting a life insurance policy is good to have, but create one that's actually going to grow for you.
Right, for sure.
Yeah. And then, like I mentioned before, an IUL that grows compoundly. Set up correctly, you can never lose. You get a base interest amount, and it does operate on the market. So if it goes below that percentage, let's say for instance 4% or 7%, if it goes below that, then you don't lose. But it goes above that, then you will gain interest on that, which creates the compound factor. Okay, and then having the foundation. The trust is your foundation. You have to protect what you've built. And a lot of people don't protect what they've built. Okay. So if you have a rocky foundation and you got cracks in it, the house is going to start leaning.
Absolutely.
So you have to build that up. And then when you have that insurance policy, allow that trust to be the beneficiary. Don't have it to where everything just get dispersed out to your beneficiaries or individuals, because starting over is hard.
Absolutely.
That's hard. And when you constantly have to start over, then it becomes a mistake. Mm-hmm. And your foundation never gets settled. It never evens itself out. It never. So just starting over, that is when it becomes stressful to the beneficiaries.
Mm-hmm. Wow, absolutely. So in terms now, life insurance, let's just say I'm 49, almost 50 years old. you can steer me in the direction to what life insurance policy is best for me versus a 64-year-old or even a 25-year-old. Are we all going to be put in different categories, different insurance policies? Will the policies and the reason I ask, because you can sign off on a life insurance policy, but then over time, the payments seem like they just continue to get higher and higher and higher and higher. Is there something that we can get for ourselves that's going to actually help us gain more money rather than pouring out more money over time, if I could say that?
Right. So the best thing, as I mentioned, is start early. When you get into the 60s, when you get into the 60s and 70s, it is expensive.
Okay.
And it's a very, very expensive. And a lot of people say, why does it cost so much? Well, you kind of started late. And having insurance policy at your job does not qualify you for life coverage. Because a lot of times you're on a group plan. Unless you have some form of retirement plan that your life insurance policy goes with you, then you're not covered. And I've experienced that with one of my clients. They thought they had been at that job for 30 years, and they had a $100,000 policy that they were constantly paying through. Once they retired, that policy went away.
Oh, and my goodness.
Now he has to start all over, and what happens is that now you're just looking at a basic, probably a whole life policy. It could accumulate cash value, but it takes a long time to accumulate cash value. So the best thing is to start young.
Sure, absolutely.
Start young, you can grow, you can benefit from it. So when it's time for you to retire, you have that. And then there's another thing with the individuals that they're in the retirement age, and then they find out that they don't have this policy anymore. Well, I tell them, if you have your 401k, and you don't need that money right away, and you're able to sustain and live appropriately, well, take some of that money and get an annuity or roll it over into an annuity. It's qualified funds. You don't need it for 2 years. Allow that money to grow, compound. And that's also what life insurance policies, annuities are. It creates life income depending on how you structure it. And you can get a monthly check, and then you can pass that money on to your beneficiaries as well.
Wow, absolutely. I mean, this is just all great news, meat and potatoes for people out there. And like you mentioned, we have these policies at work, not knowing that we should have something outside of that. Because if I'm hearing you correctly, most life insurance policies through work, some jobs or most jobs, if I can say, if something was to happen to you on that job and you go away for a lifetime, it's just going to cover that. It's nothing left over for the future.
All right. And most life insurance policies cover you when you're on the job. You have to be punched in. You can't be sitting in the parking lot on your phone and not punched into the clock, and your family wondering, I've seen it, your family wondering, where's that $50,000? Well, they weren't at work, and they wonder why they get $2,500, and they're pissed off at the company. Well, they weren't at work when it happened.
Wow.
And, and it's sad. It's very disappointing that the individual was paying for this. And the family still end up with nothing. And now you have to go on GoFundMe just to take care of your loved one. It's unfortunate, but sometimes that happens.
Yeah. Yeah, and I've heard about it, and I've seen it happen too, in the past to innocent people, So it's best to, in other words, like you said, make sure we build something outside of our jobs. Okay, and my last question here, because we're just about almost out of time. I don't want to take all of your wonderful time here. But where should someone start to secure their finances and future? Where can we start? How do we get in touch with you?
Okay. Well, the best place to start is actually pretty simple, and to, clarity is, where are you going? What do you want to do? Your income, your expenses, your debt, and build your protection around that. Those are the key basics. There's more, but those are the key basics. How much can you afford right now? It costs more to go in the hospital and get ill than it does if you have something in place and structured correctly. It can help you with those expenses and stuff that just may show up, And from there,
Absolutely.
That's how you build your foundation. Create a trust to protect what you have built for your family. Get you the proper insurance policies and have the beneficiaries be the trust. And then put your other beneficiary family members or whatnot was the charity program in there. That's how you build your foundation. That's how you get things going. And it's never too late to get started, but starting when you're young, it's better than when you're late.
Okay, absolutely. And I certainly agree. Okay, well, thank you so much, my dear, for sharing your story. Thank you for joining us all the way from Minneapolis, Minnesota today. And hopefully we can get you back on the line with us at a later time. Thank you so much and have a great day.
All right, thank you.